The number one question that everybody is asking right now, whether you're a trader or an investor, is could this correction turn into something much worse in markets? In today's video, we look at the evidence of the key levels moving forward and, of course, whether we are seeing the signs of something much, much worse. With volatility spiking, higher for longer interest rates, Tesla teetering on a flash sell, and the central bank liquidity doing something very strange, it's time for us to talk about stocks, commodities, and cryptos together. Well, welcome back everybody to The Daily Show. My name's Tom, and as always, we'll be covering the data, the macro, the lead indicators, and the hottest charts and why they could matter to you right now. If you love educating yourself about markets and learning more together, then remember to subscribe and smash that bell icon. So it was risk off across the board, but it wasn't always that way on markets. They actually opened up, and as we saw in our overall live analysis for the Monday show, which we do every Monday here on the FXE YouTube channel, then basically it was a 61.8 fib that was actually sold off across the board. This marks the fourth time this exact same style has basically occurred. And by the end of the day, it was a close on the lows, which we know means that Wall Street was holding it right on that put support, which we saw on our weekend video. But which sector was really doing well and which sectors were doing poorly? Well, it was all the risk-off sectors. Higher for longer rates hurt things like solar, clean energy, and technology, while things like healthcare, staples, and metals, which are pretty much doing well because of the geopolitical tensions, remained up high. And this has been a trend that we've kind of seen for quite a few days. Solar and clean energy not good because of the CPI results, and technology holding on mostly because of the cash buffers and the quality of the companies. Really, it's been strength in these ones though, the metals, the rare earths, and of course anything to do with energy as well. So fear for the first time back into the markets. We saw a sell that actually led into a close near the lows, and we saw fear actually tip on over here on the fear and greed index. But it wasn't just there where we saw fear starting to appear. It was in cross and asset benchmark volatility. So basically the vol across the board was spiking, whether it was the BOFA Move Index, which is going up in a big way, the Chicago Board Options Exchange Volatility Index, which again was rising, the JP Morgan Global FX Volatility, or just crude oil. Every single one of these reads is going up. And this leads us into saying, well, is this a little bit of a bigger sell-off? So on the channel, we all love a great correlation matrix, and this is a good one. This is the SPX overlay from Podcast over on X if you want to follow him. Basically, it is a correlation cutoff of 0.93. And what you'll notice here is that there's similar years, we tend to have a lot of turbulence around this point when we've followed a similar trajectory. Now, this is exactly what we've been talking about for some time, and most circumstances actually come out the other end in terms of bullishness. Now, as that turns out, it follows presidential election years pretty strongly, and we'll go through that data later on. But if you've been watching the channel, you'd start to get a bit of an idea that this is kind of normal in these markets and actually very, very healthy if it continues to do this. The percentage of stocks down 10% from their 52-week highs, that's starting to increase in a big way. And you would always expect that along with percentage of stocks below their 20 moving averages to accelerate first. And then we start to see usually a huge acceleration of the 20 as well, 20% down. And then sometimes we get into the 30 and 40%. What you're really looking for is you don't want a market that has too many of these. The 40% from 52-week highs means there's something very sick going on underneath. And we don't expect that to occur at this stage with the evidence that we have. Now, what evidence do we know, though, in terms of markets starting to lose their breadth? Well, we've been talking about energy, we've been talking about gold, been talking about materials, and they still remain the strongest sections in this market right now, with people that are in energy stocks barely feeling it in comparison to people that have been in maybe some of the tech stocks or, of course, risk-on style stocks recently. So all of those breadths are starting to show reds across the board, and that's a big increase from where we were last week. So then we go to the question, well, are we in a correction? Are we in a crash? Are we in something worse? Well, if you look at main metrics that people consider for things like corrections, you'll notice that we're generally speaking still quite healthy in markets. And we'll be looking at some key levels today where I think the bulls could sit still in these markets and why you don't necessarily want to be freaking out just because the markets are selling off right here. Remember, it is very healthy for markets to give up some of their gains, and you shouldn't just have a vertical trip all the way to the moon. Now, that's contrary to most people's beliefs, but of course, that is something we're looking at. So in a lot of the metrics, it is showing corrections still in terms of territory. And of course, we had that euphorism from the retail traders as well that we saw in most of the sentiment reports, the name, etc. So it really is a point where we've had a very strong market, a very strong move, and it's time maybe to see this pullback get a little bit worse before it gets better. You can also see from the S&P 500 forward 12-month PE that we are still well above the 19, which is the last 5-year average forward 12-month PE, and that we're well above the 10-year forward PE. Now, you sometimes do get opportunities to get these 10-year forwards, which we had back in 2022-23, but what if we could get into the 19 category? What if we got 19.5? Would that be enough for you to be considering this market? Well, let me know in the comments down below. What are you looking for in this market right now? I also put this into the weekend video and we had a look at it together, which is the percentage of stocks above the 20 moving average, 50 moving average, and 200 moving average. For a lot of dollar cost averages, they often look towards this level here on the 50, which is between a 20 and a 30. And we will update you if that happens as we go through the charts together moving forward. Notice also that the RSP is up here, and this is the area where we have strong demand. So if RSP comes into this area, we will be looking at the equal weight to make some decisions on whether price action is starting to find a base at those levels. So the S&P, let's get into the analysis together. First up, it's pretty clear that it broke the first bull level, and we'll go through why this trend has actually shown the same thing 4 times across the board. Now, with the close on its lows, of course, that is quite negative towards the market, and it points towards getting the magical gap filled. Now, this gap sitting at 49.82 has been sitting here for a very long time. In fact, it's all the way since February 20th of this year, and it just so happens to be the weekly 20 moving average. Now, if you know anything about mean reversion, the weekly 20 moving average is a very common market pullback zone within very large bull moves. So within very large bull market moves, this is sometimes all you get. As it turns out, that sits around 5,000, which will become very important as we look at it. But let's go down to the 5-minute chart for the real market open and close. And you'll notice again, it was selling throughout the day. The bears were in full control. They managed to push it up to a fib we'll talk about. They've left a gap behind here, which is of course that 5,200 gap. And then they just sold and sold and sold and sold and sold, basically closing right on the low. So let's go to the futures and take a look at the options. What did the 0 DTEs tell us? Well, in the previous video, we talked about the 50-50, 50-60 zone being where there were a lot of puts. And of course, we talked about the idea that if the market was to rally, which I expected it to rally on the session, kind of what I thought on the weekend was we might actually open down here and then gap up. Instead, we opened on our second bull zone, 5100-ish, and we gapped up and we started moving into the most traded zone. Now, it's this most traded zone that becomes important, but also the fibs. So let's just jump into the smaller timeframes here and look at the kind of bigger, deeper pullbacks that we've seen each time. Now, every one of these was pulling back to a 61.875 fib as we came down. It was no different throughout the Monday session. Now, if that occurs again and we get a deeper pullback in markets, I'll just kind of put that on the chart so you guys can see it. And it would be a market pulling all the way up to around 51.20. So does that make sense? Well, I think we really need to go for that weekly 20 moving average. It would be nice to actually see the markets get back down, fill that gap between 49.85 and find some support buying here. At least this level is really in the cards, you would think, at this stage. So even if we rally, you would have to think that the market is kind of gunning for that 20 weekly moving average. Now, does that mean that we're in a bear market? No. A bear market is characterized generally by 20% down, and a correction is kind of like somewhere between 5 and 10%. And some people say correction is actually 10 to 20. But either way, it is a pullback in the market at this point. If we end up keep going through this level, though, where's the next stop? And does that mean that we'll be going bearish? Well, to me, it could be actually quite a large fall off from there down into the 4,700 structural zone territory. And that still puts us into a bull trend. Remember, we have had an incredible move. To pull back to any of these levels, such as bull level 2 or bull level 3, is just healthy for markets. And getting the narrative out of the way for a second, when we're looking at trying to make decisions in markets, we've got to take that kind of feeling out of it. Instead, we've got to say, okay, what's the evidence at hand right now? Is this a drop in the ocean in terms of pullbacks? Yeah, of course it is. It's nowhere near a very significant one. If it was sitting at 61.8, well, that would be way more significant. But this would be about a 50% fib. And I think this is something that a lot of people want, that 47, 4800 structural zone throughout this level of demand. I would keep an eye on, though, for the 49.63, 49.80, 5,000 level. And the reason is simple. It's got to do with options. Let's take a look at what we expect over the next 24 hours and then 48 hours from the options side. And you'll notice that we're starting to already move down to it. 50.25. The most struck put level now for Tuesday for the 0DTEs is here. So we've been talking a lot about the negative gamma situation we find ourselves in. And as we can see here on the charts, 50.25 is now one of the biggest zones for the markets over the next 24 hours. If the markets do end up staying low and hold through the session to the low side, we may need to see further hedging, which can cause sells into the futures. And being in a negative gamma situation is just the opposite of what we've had most of this year, being the positive gamma situation and the squeezing towards the upsides. There are a couple of strikes, though, that become very close of mind. This week's OPEX, that means it's the big options expiration, and there's usually trillions of dollars at stake. 5,000 is now the most well-struck level, and that is a zone that just so happens to sit around the gap fill and the 20 weekly moving average. So I think for a lot of traders, we're going to be looking at what's going on between the 5,000 and the 49.80 zone from the bull side. So be careful around there, and I think this is where you're looking for structure, and potentially bulls will be looking for small time frame buys to hold it above that zone. If 5,000 does get broken through, though, and markets hold underneath, well, you can see there'll be a lot of hedging that's needed. So options will be paramount to be watching this week, and we'll bring it to you every day throughout the videos. S&P 500 versus CTAs. The systematic funds have been selling, and they probably have more selling to do. I've updated this one. We'll get some more data in, hopefully, over the next couple of sessions. And I expect the CTAs to at least want to push down into kind of these positions where they were before. Now, it's not just in the S&P. The CTAs in the NASDAQ have also continued to sell. If we get an uptick in those, it's a good sign that maybe the base is in, and we'll be watching that along with the charts. Also, what about sentiment in terms of risk on and risk off? Is it a great time to buy markets or a great time to sell them? Well, we're probably around here at the time of the recording. If we get into the opportunity side, we'll update you. But at this stage, we're kind of in the no man's land. Is it a great time to do anything in particular? Well, maybe there's a little bit more downside coming first. So one of the stories that most people didn't care to talk about was the retail sales. And this sent all of the yields up in a big way. It was pretty strong. Here we've got some of the previous retail sales reports, and you might notice a clear kind of sign here, which shows you that we have a market that is getting hotter and actually a very strong kind of retail economy. 0.7% means higher for longer, and it's across the whole board. The only thing that was really down was clothing and sporting goods and hobbies. So there was some very, very strong results coming out of the US economy, and it means that there's only one rate cut now on the horizon for this year, which is down from like 4 to 5 at one point. Emerging markets is also an area I think not enough people are discussing. If you're familiar with lost decades, we'll talk about this in the show, emerging markets have actually been looking at one of the worst periods in a very, very long time. And the one standard deviation is now all the way down here. And you'll notice it hasn't really hit these kind of low levels since the 90s. Are we going into a boom for emerging markets? I'd be very interested to know what your thoughts were down in the comments down below. With the geopolitical situation, it certainly seems to me that emerging markets are worth a look again. And it's been pretty much I've never had to look at them in my trading career so far since the global financial crisis. Let's go over to the big earnings. So the big earnings is really Netflix, and that's the one that most people will be watching this week. The kickoff of big tech, then next week is going to be absolutely bonkers, but Netflix is the big kickoff. We've got a lot of banks still coming through, and yeah, as general, Goldman Sachs was a decent report. They made a lot of money out of all the bonds that are being issued at the moment, but yeah, we know that Netflix is the one that most people will be watching. +9 or -9% is the implied move from the options market. It is going to be a big event. So we talked before about the idea of having cross correlations, and that in election years, we tend to see kind of these sideways movements. Remember, we were very well correlated just recently with 2012 and 1976. So just like the other chart, it makes sense that we are where we are, and we're also pulling back to around the same point. Are we in a longer term bull run? I think yes. I think the secular bull run is still going. And this also just turns out to be a correlation as well with periods of points where you expect markets to find some sideways action and maybe even correct a little bit before resuming their bull runs. So let's kick off dark pool activity. And really the major one that I saw over the last 24 hours was this. It was on the 2XQ fund, QLD. And although it's not traded that heavily, this one was 238 times larger than any of the largest trades that were placed before. It's a big kahuna, and it came out of nowhere as a dark pool sweep. Now, will it be defended? So a lot of the thing is you'll want to have this probably on your charts and see how markets interact with this particular zone. When you're using dark pool or large activity, you are, of course, looking for interaction with the zone to see whether the bulls or the bears are winning. But it was right at the close, and it was a monster transaction. We also just wanted to put this one in again, which is, of course, when the gold trade is so bullish and it's above these 77 reads on the RSI, you might be leaning towards the negative side. I wouldn't be doing that. When you see this, the annualized returns for gold are very positive. We've had it before, and it only happens 3% of the time. So let's jump into the charts, and we'll start off here with the volatility index. Well, it's been a while, 19 on the close. That's a very high VIX close considering where we've been ever since really September and October of last year. But whenever you enter into this territory and close on the highs, it does signify that there may be more selling to come on markets. We also see here that the US high yield options have been on the increased tick. So this is again showing you that there is some fear, there's some concern out there. And this is the one that I thought you would all be very interested in. This green line kind of tracks the Federal Reserve's liquidity and all of the tools that they use to actually provide support to the market. Now, out of nowhere, that just upticked massively. And yeah, does that look like some intervention into the markets? I potentially think it is. And we saw something similar to this happen over in that last corrective period. We got this huge injection. It dropped off. It injected again. You can see the big injection here supporting the market. And then it remained very, very bullish throughout this run and neutral. So yeah, a big injection here from the central bank liquidity. Also some on the world central bank side. So clearly, you know, the wheels are in turning just in case this gets out of control. And I wouldn't be surprised at all if ultimately the Federal Reserve is sitting there behind to support the markets if things get a little bit too concerning in what is an election year. US 2-year, you'll notice is 4.9. You can also see US 10-year actually made it to a new high in terms of where we were at. So this is showing again that the economy overall is quite strong, and it's going to take more from the Fed and higher for longer rates, which was the reason we sold off, well, supposedly the reason we sold off during October and September of last year. And this time around, the markets are taking it in their stride. High yield junk fell right through 76. Again, this is a big deal. We know puts are sitting around this level, so they may need to be hedged in this week's OPEX, and it's leaning into potential of further sell-off, as high yield junk shows us that effectively bonds are starting to freak out a little bit in markets. Dollar index also looking strong, 106.16, probably moving towards the 106 kind of 80 zone. It's been a very strong trade here for dollar bulls, and dollar bulls will be happy with the retail sales report. Higher interest rates usually lead into higher US dollar. Copper also holding its own. As you can see here, the metals all did well off the geopolitical tensions, and they're holding in the markets. Gold also holding very well. Now, I thought gold might struggle a little bit around this zone, but this is the trend line that I've got drawn through the back, and it got taken early in the session and then came out with a big bullish pin bar. Once it closed through there, this little scalp and possibly still staying in on the markets might have been a good bull move for the traders out there. But yeah, gold, I think, still could be taking a breather here. I've got long-term plans. 3,000 doesn't change for me. But yeah, right now, you know, very, very strong, good trend line, good hold. If that gets taken, well, back down to 2270, probably a pullback in time for gold at that point. Now, is silver going to do better than gold? The ratio still suggests, yes, silver does look better than gold in the current markets, and 0.013 would be where you're looking for in terms of the ratio. Remember to always ratio up some of your trades so you can see how they're comparatively performing. A good one is also in crypto markets when you're looking at Ethereum versus Bitcoin to find out the alt season pickups. And then, of course, you go into the other coins from that stage. US oil still holding strong, came back down, took the low, found two big wicks off this level here, and then a big bullish move. I think that's kind of bullish for oil because it managed to take the lows and it bounced through. So I guess I'm on the bull side here for oil still. A lot of people thought that it should go up immediately due to the weekend stuff. You've got to remember the left-hand side was already running. Remember, metals, energy, everything was running months ago into these geopolitical tensions. So it's already been moving up there. A break of the 87 high should expose 91.14. And of course, everyone's now talking about $100 barrels throughout oil. Let's move over to Tesla. It's really bad close. There's nothing else you can say about it. Tesla seems to be pivoting into data centers, which I don't think is necessarily a bad thing. But yeah, this is a very bad closure for Tesla. If it does bounce, I'd say it's unusual. And that's because the weekly ended up closing with that wick down. It's come back down, pressured this area that we've already seen. And I think we could be going towards 152. So a break of the 160 low, the chance of going to 152 becomes quite high, and this area could happen fairly quickly. So again, if markets continue to weaken, you can watch Tesla and have a look at it. Nvidia pull back here. Some people will like this zone for Nvidia. Nvidia bulls will be like, oh, 61.8 fib, I want to buy it here. We've already talked about the 830 being the put wall, and if we do end up getting a further correction, you want to mark in the 780 to 800 and 673 to 680. And you might think that's impossible, but I've learned with NVIDIA over the years, anything is possible. It's just some of it doesn't happen exactly when you think it will. What about Apple? Weakness after its strength, no breakthrough of 180. So really just still in consolidation for Apple with the weakness tinge there. And then there's Netflix. This week is Thursday Netflix, and it is consolidated. So we are in a coiling market, which, as you know, if it breaks out, tends to be an aggressive move. We've been watching junk bonds do that recently. So we are waiting with this. And a 9% move to the downside, I think, takes us straight into the first sup. And then 480 would also be an incredible level to be looking at. I kind of favor the 480. I think this earnings season is going to have a lot of 20% movers, and that's why it's going to be really exciting. So make sure to sub to the channel if you haven't already, because that is going to be exciting times with some great trades due to huge amounts of fear and possibly even some greed in these markets. Oz 200, let's have a look back down to the first major support of 7,600 level here. It's trading right now as we speak, so you can see that it's come back down to the weekly 20 moving average. This is pretty much where you'd expect it to find some buyers. At worst case, 24.50 would be probably where I think the Aussie market's going for now. Same thing with the German market, a very negative candle, guys. When I saw that this morning, we saw it booming in the previous open, and then it got smashed back down. Now, because it's made a new low, that's actually a very negative sign, and it points towards the DAX showing further signs of weakness. Now, how bad could the DAX get? Well, again, Fibonacci's are sometimes your friend when it comes to looking at how far pullbacks could get. Most people will be looking at the 38.2, which is coming up. And then underneath that, I think it could be actually the 61.8, which sits around 17,250. So two key levels for the bulls, dollar cost averages, and other people out there. Moving over to the Chinese market, not down as badly as the others, but still in the descending channel here for the CQQQ, which is another way to look at it. We talked about HSI. We've talked about the improvement in, I think, the improvement off the base of economic activity with all of the negativity in the markets and those big volumes, and it's still holding its own, kind of just like floating around with the rest of the markets at this stage. US 2000, bad close. Weekly, that's a very, very bad close for the markets. On the lows, points towards further sell-off. 1943, probably around the level that maybe a buyer might be there for the US 2K. But this is now actually quite a significant sell-off. You can see here the percentage is down 8.17%. So small caps certainly taking a big dive. And maybe now we're looking towards that 1940. So not too many more points until maybe some bull reprieve. Same thing on NASDAQ, broke below 17,780, which we've been talking about for a while. Weekly 20 moving average sits at 17,004. I would not be surprised at all to see this level reached over the next coming sessions. Maybe it's going to take earnings season. It's going to be interesting either way. Very, very key levels. Now let's move over to the crypto market. So we'll start off here with Ethereum. So Ethereum hit bull zone 1, which is kind of like a well-traded zone on the way up. If Bitcoin manages to fall through 60 though, Ethereum may flash into this structure down here. taking it down to 2,280. So that level is also very, very important. Current market is showing signs, of course, of the pullback, which we've been talking about after we had that bit of a blow off. And Bitcoin is barely holding on to our bulls hold level. So this has been very important bulls hold level. We're looking for the market, if it goes underneath 60, to go to potentially 52,000. So that's going to be a fairly big flash sell. And it wasn't able to regain, I say 70K zone here, but the 68 level. So 68 is where the major bulls are. And if you have a look here, it's just kind of structuring with bears in control on the smaller timeframes. If you enjoyed today's video, please make sure to subscribe, guys. There's still some news coming out this week, but really it comes over now to Fed Chair Powell speaking, and that's happening literally in the next 24 hours at 1:15 p.m. New York time. And then, of course, we've got the big earnings report from Netflix. Subscribe if you enjoyed today's video. Thanks so much for watching. See you in the next one. Bye for now.